The Strait of Hormuz. Why one waterway holds the global economy hostage. As of today, peace talks between the United States and Iran have collapsed. 21 hours of negotiations, no deal. And President Trump just announced the U.S. Navy will begin blockading the Strait of Hormuz. Here is why that matters to you. Even if you've never heard of the Strait of Hormuz, roughly 20% of the world's entire oil supply passes through a waterway that, at its narrowest point, is just 21 miles wide. That is not a typo, 21 miles. And right now, Iran controls who gets through. Since the war began on February 28th, oil prices have surged 44%. Gas is now above $4 a gallon nationally. Inflation jumped to 3.3% in March, the fastest pace in nearly 2 years. And the stock market's best-performing sector isn't tech, it isn't healthcare, it's energy, up 28% this year while the rest of the market is down. In this video, I'm going to break down what the Strait of Hormuz actually is, why it has this much power over the global economy, what the market data is telling us right now, and what you as a retail investor should actually be paying attention to without the panic. Let's start with the basics, because this is a topic where the geography matters a lot. The Strait of Hormuz is a narrow waterway between Iran to the north and Oman and the UAE to the south. It connects the Persian Gulf, where most of the world's largest oil producers sit, to the rest of the global ocean shipping network. Think of it as the only exit door from a room full of oil. Every single barrel of oil produced by Saudi Arabia, the UAE, Kuwait, Iraq and Iran that gets exported by sea has to pass through this strait. That accounts for roughly 20% of the world's total oil supply and about 20% of the world's liquefied natural gas, or LNG. According to the International Energy Agency, the closure of the Strait of Hormuz, triggered by this war, represents the largest supply disruption in the history of the global oil market. Bigger than the Arab oil embargo of 1973, bigger than the Gulf War in 1990. This is not normal. This is historically significant. The war began on February 28th when the United States and Israel launched military operations against Iran. Iran responded by restricting shipping through the strait. By early March, the blockade was cutting off 12 to 15 million barrels of crude oil per day from reaching global markets. As of this morning, April 12th, peace talks have failed. Iran is still restricting access. The U.S. Navy blockade is being threatened. The 14-day ceasefire expires on April 22nd, and there are currently no talks scheduled. We are in uncharted territory. Let's look at what that actually means for markets. Let's talk about oil first, because that's the most direct channel through which the Strait of Hormuz affects everyone's daily life. Before the war started on February 28th, West Texas Intermediate, the U.S. oil benchmark, was trading around $66 to $67 a barrel. By early April, it had crossed $100. That's a gain of roughly 44% in about 6 weeks. Brent crude, the international benchmark, is up about 31% over the same period. Now, oil price increases don't stay in the oil market. They flow through the entire economy very quickly. Here's how that chain works. Higher crude oil prices lead to higher gasoline prices at the pump. Gas hit $4 a gallon nationally by March 31st, up more than 30% since February. That feeds directly into inflation. And we saw exactly that in the March CPI data, released on April 10th. Headline inflation came in at 3.3% year over year, the fastest pace in almost 2 years. Gasoline alone accounted for about 75% of the monthly price increase in March. But here's the part people often miss. Oil doesn't just show up in your gas tank, it's in the price of plastics, fertilizer, shipping, airline tickets and manufactured goods across the board. When energy costs go up, so does the cost of producing and moving almost everything. The International Monetary Fund has called the Iran war's impact on global energy markets a major stagflationary shock, meaning it raises prices and slows growth at the same time, which is the hardest combination for policymakers to deal with. The Strait of Hormuz crisis is bigger than oil, and this is what a lot of the coverage is missing. The World Economic Forum released data showing that 9 major commodity categories are facing supply disruptions because of this crisis beyond crude oil. Let me walk you through the most important ones. First, liquefied natural gas, or LNG. Iran struck Qatar's Ras Laffan industrial city complex on March 18th. Qatar is one of the world's largest LNG exporters. That strike caused a 17% reduction in Qatar's LNG production capacity. As a result, LNG spot prices in Asia jumped over 140%. Europe was already entering this crisis with gas storage at just 30% capacity after a harsh winter. Dutch TTF gas prices nearly doubled in response. Second, fertilizer. Fertilizers are made from natural gas, primarily ammonia and nitrogen compounds. The OECD projects global fertilizer prices could average 15 to 20% higher in the first half of 2026 if the crisis continues. That feeds directly into food prices, which we haven't fully seen in CPI data yet, but will. Third, aluminium. Aluminium smelting is extremely energy-intensive. Higher energy costs in Europe and Asia are pushing aluminium prices higher, which flows into the price of cars, aircraft, packaging, and electronics. This is what makes a Strait of Hormuz closure fundamentally different from a typical oil market disruption. It's not just about filling up your car. It's a shock that moves through food supply chains, industrial supply chains, and energy grids simultaneously. Here's where it gets directly relevant to anyone who has a 401k, an IRA, or a brokerage account. The S&P 500 is down about 4% for the year. The NASDAQ entered correction territory. That means it's down more than 10% from its recent peak. And most sectors are struggling, but the energy sector, companies like ExxonMobil, Chevron, and the broader XLE ETF, is up 28% year-to-date. It's the only major sector in the green. That split tells you something important. Markets aren't collapsing, but they are repricing for an environment where energy costs stay high. The bigger question, though, is what this does to the Federal Reserve. The Fed's job is to manage inflation and support employment. Right now, it's failing on the inflation front. 3.3% CPI is well above its 2% target. Normally, the Fed would respond to that by raising interest rates, or at least keeping them high. But the economy is also slowing. The unemployment rate has crept up to 4.3%, and job growth has weakened. So the Fed is stuck. It can't cut rates to help the economy, because that would fan inflation further. It can't raise rates to fight inflation, because that would slow an already weakening economy. The FOMC meets on April 28th and 29th, and markets are pricing in 0 rate cuts, no change. This is what economists call a stagflationary environment. Historically, it's one of the most difficult conditions for a balanced portfolio. Stocks struggle with slower growth, bonds struggle with rising inflation, and cash loses purchasing power. We haven't been in a stagflation episode of this severity since the 1970s, and back then it took a decade and some very painful interest rate hikes to get out of it. I'm not saying that's where we're headed. The ceasefire, even a fragile one, could change everything very quickly. But right now, that's the risk the market is pricing in. Let me show you what the charts are actually saying right now. Starting with the S&P 500. The index is currently trading around 6,591. There's something on this chart worth paying attention to. A death cross. That's the technical term for when the 50-day moving average crosses below the 200-day moving average. It happened in late March, and it's the first death cross we've seen in years. What does that mean? It's a bearish technical signal. Historically, death crosses often precede extended periods of sideways or downward price action. It doesn't guarantee anything, but it tells us the trend has shifted. Right now, the key levels to watch are 6,664 on the upside. That's the 200-day moving average, and a sustained close above it would be the first real bullish signal since January, and 6,500 to the downside, which is the first significant support floor. A break below 6,500 puts 6,300 in play. The NASDAQ composite is at around 22,903. The index entered correction territory in late March. That means it fell more than 10% from its October 2025 peak. It got a relief bounce on the ceasefire news, but the chart remains bearish until it can reclaim its 200-day moving average. The level to watch on the downside is 21,033. That's been acting as a battle line between buyers and sellers. A sustained break below it would signal the next leg lower. Now let's look at oil, because that's the heart of this story. WTI crude went from $66 before the war started to above $100 during the conflict, a 44% surge in about 6 weeks. After the ceasefire was announced on April 8th, it crashed 16% in a single day to $94 and change. That's the sharpest single-day oil price drop since April 2020 during COVID. The key technical levels, $90 is support. That was the ceasefire low, and a lot of buyers stepped in there. $100 is resistance. It's a psychological threshold that the market keeps coming back to. If we see a genuine resolution and the strait reopens, analysts suggest oil could fall back toward $80 to $85. If talks break down completely, and today's news suggests that risk is real, then $110 to $115 comes into view, with Goldman Sachs and other banks warning that a prolonged closure could send Brent above $150. Finally, the sector picture. Energy XLE is up 28% year-to-date. Every other major sector is either flat or negative. The S&P 500 overall is down 4%. That divergence is not subtle. It's telling you exactly how markets are pricing the Strait of Hormuz risk. Higher energy prices are good for energy producers and terrible for almost everyone else. So what do you actually do with all of this? 3 things worth thinking about, none of which require you to make any sudden moves. First, understand what you own and how it's exposed to energy prices. If you hold a broad S&P 500 index fund, energy is only about 3.5% of that fund by weight. A 28% surge in XLE moves your total portfolio by about 1%, meaningful but not catastrophic. The bigger risk is if high oil prices feed through to corporate earnings broadly, which would take months to show up. You don't need to rebalance your entire portfolio today, but it's worth knowing how much energy exposure you actually have. Second, watch the inflation data, not just the headlines. The next CPI print is scheduled for May 12th. That will cover April's prices, and April is the first full month with gas above $4 a gallon. If inflation comes in above 3.5%, that significantly raises the chance the Fed has to take a harder stance on rates, which puts more pressure on both stocks and bonds. That number will matter more than almost any individual news headline between now and then. Third, the April 22nd date matters. That's when the current ceasefire expires. Between now and then, watch whether new talks are scheduled. If both sides return to the table, oil prices will likely fall and markets will likely rally. If the ceasefire lapses with no new talks, expect the opposite. This is not about predicting the outcome. No one knows. It's about understanding what the binary scenarios look like, so you're not caught off guard by either one. This situation is moving fast, but the key principle holds. Stay informed, don't react to individual headlines, and make sure your allocation reflects your actual risk tolerance, not the anxiety of a news cycle. The Strait of Hormuz isn't just an oil story, it's an inflation story, a Fed story, and a stock market story all at once. A 21-mile-wide waterway is currently dictating what you pay at the gas pump, what the Federal Reserve can and can't do about rates, and how your retirement account is performing this year. The situation remains unresolved as of today. Peace talks have failed, a Navy blockade is being threatened, and the ceasefire expires in 10 days. We'll be tracking every major development on this channel and breaking down what it means for your portfolio in plain English. No hype, just data. If this video helped you understand what's actually happening, drop a comment below. I read every one. What angle do you want me to go deeper on? The oil market mechanics, the Fed's policy bind, the historical comparison to the 1970s? And if you're not subscribed yet, now's a good time. We publish every week covering macro events like this one with the same format: what happened, why it matters, and what to actually do with the information. This video is for educational purposes only and is not investment advice. Always consult a qualified financial advisor before making investment decisions.